So our first speaker today is Edith Frison, Business Advisor, Taxation Services with MNP. Edith is a Senior Manager from MNP's Southern Manitoba region. Edith is a Chartered Professional Accountant qualifying as a Chartered Accountant in 2009, working out of her Brandon office. Edith practices in the areas of corporate and personal tax planning and compliance. Her focus is on succession and estate planning, as well as the tax reorganization. She has worked in specialty tax for over 10 years and has completed her CPA Canada's in-depth tax course. Edith, take it away.
Good afternoon.
I'm sorry.
That's good. My name is Edith Frison, and like Dave said, I work in the specialty tax group here in Brandon with MNP, focusing mostly on ag. So if anybody attended my presentation last year, I'm going to piggyback a little bit off that presentation. Last year I talked about the legislative changes that were introduced on July 18th, 2017 from the Department of Finance. And essentially that contained three major areas of overhaul in the Income Tax Act. And it was the largest change in the Income Tax Act, or proposed change in the Income Tax Act, in 45 years. It focused on income splitting, holding passive investments inside of a corporation, and converting income into capital gains. When I talked about it last year, it wasn't a reality yet. It was still proposed legislation. This year, I'm going to talk a little bit about what happened and how actually is it going to impact your firm this year, or from now on, because it's real legislation now. So I'm sure most of you will remember in 2017, there was some threats about how the capital gains exemption was going to be able to be used into the future. And there was a huge lobby, mostly from the prairies and west, of the federal government saying you can't take away our ability to use our capital gains exemption. And because of all the time and effort folks put into that, we actually did change the government's mind. And they backed away from the legislation that was going to limit the availability of the capital gains exemption. And just to make sure everybody's familiar with the capital gains exemption, everybody in Canada, every taxpayer, every individual has a lifetime capital gains exemption. And for certain types of property, which includes farm property and shares of a farm corporation, that amount is $1 million. So if you were to dispose of farm property that qualified for capital gains exemption, you could shelter the first $1 million of gain, which is huge. And we try, I'm sure every accountant who works in ag tries to be sure that we use up that capital gains exemption before anybody were to pass on the farm. So my focus today, this is just the legislation or the information circular. When CRA decided to walk away from the capital gains exemption or attacking the capital gains exemption, it was in October of 2017. So good work. So sprinkling income using private corporations, this is essentially still inside the legislation. They didn't change it. It didn't fall out exactly the way I explained it last year, so I'm going to talk about it a little bit this year. I'm going to tell you right now, it's heavy and technical, so I'm going to try my best to make sure that you understand it when we leave here today. If you're not familiar with income sprinkling was a method that we used to use in the past to ensure that a family paid the lowest amount of tax possible. Historically, before this legislation was changed, we could pay a dividend of any amount to any shareholder inside of a corporation. This legislation changed that. Now a dividend has to be considered reasonable or fit inside one of the 4 exclusions to be sure that it isn't subject to this new legislation and taxed at a much higher rate. So when we were income sprinkling, the best example I can think of is when we have a child who's going to go to college or university. If we paid mom and dad an additional $20,000 dividend, they would be taxed at their marginal rate. And mom and dad are probably already taking a salary or dividends out of the corporation, so that would put them at, let's say, a 25% tax rate. If we paid that same dividend to the child who's going to university, or college, we might be able to shelter or might be able to pay very little tax because that individual would have their basic exemption, and then they would also have some education and tuition credits. So when your GP or your general practitioner would look at your family as a whole, they would do a plan to make sure that your family paid the least amount of tax possible. So if we paid that salary or dividend to a child and they paid zero tax, that's much better than mom or dad paying 25% tax. So there was some real tax savings achieved. Unfortunately, that's not going to work anymore. So the tax on split income legislation, or we call it TOSI, is effective for any dividend paid after January 1st, 2018. Like I said, the rules are super complex and subject to interpretation, but I'm going to give you a general overview today. CRA has given us some bright line tests and a bit of guidance, but until anything goes to court, we really have nothing to rely on. So I'm not sure who wants to go to court over this, but if you do, you could set a precedent for us and help us make our decisions about whether or not we're going to pay dividends to individuals. What's the consequence of falling into this new legislation? Well, it's pretty severe. If you have a dividend or any other kind of income from a corporation that's subject to the tax on split income rules, it will be taxed at 50%. It's approximately 50% in Manitoba. So I can guarantee you I could probably structure your remuneration strategy inside your corporation so that you'd pay less than 50% in some other way. So we really do want to avoid falling into this legislation if we can. So, does TOSI apply to you? The types of income that are subject to tax on split income, and I use dividends all the time because that's probably the one we see the most often, but it also could entail partnership income, any interest income, or CRA magically put in other, which could mean anything, we're not sure. It's probably if they see that you paid a dividend or paid salary, or not salary, but if you paid money to an individual and they don't like it, they're gonna stick it in that other category. So we have to be super careful when we're paying out money out of our corporation to individuals. We don't wanna fall in that other category. And are you a specified individual? And the specified individuals are considered related to the shareholders. And who's considered related? Well, you're related to your grandparents, your parents, your spouse, your siblings-in-law, and that's all for now. When CRA, and when I talked about this last year, CRA included both capital gains and the types of income that would be subject to the tax on split income, and they also included nieces, nephews, aunts, and uncles inside the related party definition. They've actually backed away from that and repealed those parts of the legislation, so that's good, I think. So could TOSI apply to you? So I kind of looked at it and thought of some specific scenarios that we are seeing where TOSI does apply. Does your farm corporation gift any shares to your children and then redeem those shares? That could be subject to TOSI and that 50% tax rate. If the corporation's paying dividends directly or through a family trust to your spouse, your sibling, adult children or parents, those amounts could be subject to TOSI. Is a corporation that's run by your adult children redeeming your preferred shares over time, and that results in dividends to you, that could potentially be subject to TOSI. Did you receive interest amounts on any amount that you loaned to your child's corporation? Also could be subject to TOSI. Or do you allocate partnership income to any members of your family? So how do we get out of TOSI? How do I avoid paying tax at this super, super high rate? CRA has given us 4 exclusions. If you fall into any of these exclusions, then you will be taxed at your regular marginal rate when you receive these amounts. And if you Google it, they're called the safe harbor, the excluded business, the excluded share, and reasonable rate of return. And I'm going to go through each one sort of briefly to give you an idea of what's inside each one of those exceptions. Like I said, if TOSI applies, it will be a tax rate of about 50%. and you actually don't get any access to the credits that you would have otherwise had available. It's actually on the tax return, it comes in right at the very end and subject, boom, to 50%. So it's quite a penalty, and they're really trying to design it so that they're trying to prevent people from falling into this legislation, or they don't want you to pay these amounts out to individuals in your family. So the first exclusion is the safe harbor exclusion. So if you're 18 to 24 years old and the property was acquired as a result of the death of one of your parents, then these dividends would not be subject to TOSI. Now, this is sort of a warning sign, or one of the things I want to warn you about is we have to make sure our wills are up to date, because if it's not inside the will, if it's not inside a written document, this probably will not fly. And the same theory goes with certain matrimonial divisions. So if you have marital breakdown and you've decided with your lawyer and whoever that you're going to pay your spouse out over time and you're going to pay her dividends out of the corporation, and I use her because that's typically the way it works, we have to make sure that that is allowed for inside of the legal separation and the legal divorce agreement, or it will not be outside of the tax on split income rules, or if the individual is over age 65. The second exclusion is called excluded business, and this is a business if the individual receiving the dividend is actively engaged on a regular, continuous, and substantial basis of the business in either the current year or 5 previous taxation years that don't have to be subsequent or continuous or recent. So this one sounds easy on top, okay, on surface, okay, yeah, regular, continuous, and substantial basis, done. But accountants like to get into the nitty-gritty, and we like to talk about what every definition means. And so we asked CRA for some guidance. And essentially what CRA said was, if you want to be considered actively engaged on a regular, continuous, and substantial basis, the test is 20 hours a week. So then we go back to CRA and we say, well, lots of corporations wouldn't necessarily have an employee 20 hours a week, and farming's probably a very good example of that. There would be, 100 hours a week during busy season, but maybe much less right now. So CRA came back to us and said, okay, well, depending on what type of business it is, we'll take that into account. So my best defense, if this is the exclusion that you're relying on, is you have to have some kind of documentation that proves the individuals who receive the dividends outside of your corporation were actively engaged on a regular, continuous, and substantial basis. So things like timesheets, job descriptions, emails, if they have them, mileage logs, if they've been running a truck back and forth to the city, anything you can think of that will substantiate the fact that they were actively engaged on a regular, continuous, and substantial basis. What about if the business has ceased? And so this is a big thing that the accountants and lawyers and CRA are all discussing. So if the business has ceased, and the best example I can think of is, let's say mom and dad have a farm and they've built this farm and all of a sudden it's worth $10 million. And in 2015, they sold that farm and now they have $10 million cash in the bank and it's invested inside a corporation. Well, when CRA looks back to actively engaged on a regular and continuous and substantial basis, are they going to look back to the farming years? Or are they going to look at the fact that this changed from a farming business in 2015 to an investment corporation? Because they've sold out all the active assets and now they just have assets invested. So there is one school of thought that, yes, we should look back to the years that they built the farm up to 2015. But there's also some speculation that that's going to fly. So if this is a scenario you're in, I'm going to suggest that as part of being inside of Investco, mom and dad have to start doing as much business as they can, or as many activities as they can, in order to manage that business. So types of things I'm talking about are Both of them should go see the accountant on an annual basis. Both of them should go see the investment advisor on a regular basis. And we should keep track of that, or maybe minutes or record of the fact that everybody was involved as much as they could be in that investco, if we want to make sure that we stay outside of the TOSI legislation. Yeah. The third exclusion is excluded shares, and this is probably the most complex of the four exclusions. You have to be at least 25 years old, and you have to own at least 10% of the votes and value of the corporation. And value is now being tossed around. Like, it's easy to give somebody 10 votes, but how do we ensure that we gave them 10% of the value? We probably have to give them 15% of the value to make sure that if there's any minority shareholder discounts, that they actually do have 10% of the value. I find this exclusion is going to be the one that causes us the most grief. It's the one that if you think you're falling into, you should really meet with your advisor and make sure that we can rely on this, that you fall into it squarely and there's not going to be any disputes with CRA. In addition to those two conditions, there's a third condition where the corporation cannot be a service business, which in farming is unlikely. That most farmers grow a product and sell that product, so you would not be considered a service business. But I want to make sure that holds true for everyone. So we should definitely do an analysis if that's the case. You can't be a professional corporation, which is a doctor, lawyer, accountants. Those are the types of people that have professional corporations. And you have to earn your income in a certain way. It can't be from a related business. That definition is pretty complex, and it's why I say I think that you should probably talk to your advisor if you're trying to fall into this exclusion. The fourth exclusion is a reasonable return. So if you're 18 to 24 years old, there's two methods. We can pay you 2%, which is considered a safe harbor return, which if you're trying to fund university at 2%, it seems like that child's probably going to have to loan or borrow a lot of money from the bank, because 2% of $100,000 is still only $2,000. The other catch to this exclusion is that the money has to be their own. So you can't gift it to them, and they'll actually trace it back. So they would have had to win the lottery or inherit it from somebody who's deceased, or I'm not sure how many university students are out there with a whack of money to invest and earn 2% on, but I don't think many people are going to fall into this exclusion, and I think it's probably the most cumbersome. You can adjust the rate of return from that 2% if there's labor contributed or property contributed or any kind of risks assumed. But like I said, it seems unlikely that anybody who's young is going to be fit this scenario. So what still works? Well, we have to plan a little better and keep good records. One of the things we can do, and we do this all the time, is let's plan into using that capital gains exemption. Because they walked away from that legislation, we still have lots of plans that will help you get some shareholder loan by using your capital gains exemption. So by all means, talk to somebody who knows how to get you that shareholder loan that you'll need in the future. Any person should be actively engaged in the business on a regular, continuous, and substantial basis, and we should have some documentation to prove that they were actually there doing work. Prescribed rate loans, like I said, 2% is not a lot, so you can still do that, but I'm not sure it's going to achieve your goal. And salaries. Salaries actually haven't been touched with this legislation, but salaries have always had to be reasonable. So you have to pay a salary to your related parties, so like to your mom or dad or your kids, that you would pay to a third party. So you can't pay them $5,000 a year for sweeping the floor once or twice. The other thing that was inside that legislation was passive investment income inside a private corporation. So what does that mean? Well, in the past, lots of farmers or lots of folks who own a corporation would leave their income or leave some of the cash inside the corporation to plan for a rainy day, to make sure that they could buy any purchases they wanted. Like farming, I'm sure most of you have some cash in there to make sure that if there's a bad year, you can still eat. You might have used the cash to secure credit lines or savings for retirement. There's lots of reasons you might leave cash inside your corporation. In this legislation, CRA decided that there was a perceived benefit for entrepreneurs where they could defer some tax inside their corporation, and that same benefit wasn't afforded to all employees. So the government decided that's part of the reason they were going to make these changes. So if you have investments inside your corporation and you earn less than $50,000 worth of investment income, you're probably still going to be okay. And I'm going to define investment income in the next slide so you know what I'm talking about. But if you earn more than $50,000 a year inside of your corporation or your associated group, for every dollar you earn over 50, you're going to claw back your small business limit by $5. And the small business limit is that 9%, just January 1, 2019. It went down to 9% on the first $500,000 worth of income that you earn inside your corporation. So if you get to that $150,000 mark in investment income, all of a sudden you have no small business limit left. A couple of the places where we're seeing people get caught with this is if they have a family trust. So if you have a family trust, you're associated with any corporations, most likely you're associated with any corporations that any beneficiary owns, and now we have to look at it as a whole. So the whole associated group can earn up to $150,000, or the small business limit is clawed back to zero. One thing we sort of see mostly in the Verdun area where lots of folks have mineral rights is if you have a farm co and a mineral rights co and you're associated, could be pretty easy to earn $150,000 worth of royalties inside a mineral rights company. All of a sudden your business limit on your farm is clawed back to zero. You might think about this as if you share your small business limit with any other corporations, that's where this is going to get a little bit hairy and need a little bit of work. What types of income are considered investment income? Well, it's interest, it's taxable capital gains less taxable capital losses, so your net gains. Any rents, including some land rents. So I think that might be something that farmers do, is rent out their land inside their corporation. That could be included in your investment income. Any royalties, like I said, inside of some farm codes we see mineral rights, and it's pretty easy to earn $150,000 worth of royalties on minerals. Any portfolio dividends, any dividends from foreign corporations, and those two are probably something you'd see if you had formal investments inside a bank. But it does exclude any dividends from connected corps. As if this was all not complicated enough, next year's small business limit clawback is based on this year's investment income. What does that mean? It means what the investment income you had on December 31st, 2019, or the clawback you'll have for 2019 will be based on the investment income that you had in 2018. So that isn't a bad loophole. At least it gives us some time to plan into the fact that you're not going to have any small business limit next year. When I talked last year, I said that the proposals had some grandfathering clauses around this passive investment income stuff. That didn't hold true, so that didn't happen. Sorry. So what can we do around the investment income side? Well, I think you're going to have to reduce your investment income inside your company. So you're going to have to go out there and buy that combine, which I know I'm the tip of the iceberg and encouraging you to buy more equipment. We should make sure to track any interest paid on debt. If we borrowed in order to invest, we should make sure that that's getting offset against this investment income. Any fees we pay to counselors or management fees we pay to the bank. Any salary, maybe we could even go as far as deciding what kind of salary we should pay the owner-manager for managing the investment portfolio. MNP and lots of investment brokers out there will have lots more sophisticated solutions like individual pension plans, things like that. That would definitely require a meeting with someone who knows about those things before you could implement them. Some other more simple issues is if you're already over the $150,000 threshold, maybe you trigger a whack of capital gains in that year. You've already lost your small business limit, so in order to prevent losing it again when you trigger some more capital gains, maybe you do it all at once. Or maybe you trigger some capital gains in a year where you have less than $50,000 worth of investment income. Just a couple of ideas. This is how I feel about this legislation. It's mostly the Minister of Finance asking for all your money. And that's it. So does anybody have any questions? Or I can take questions at our MNP booth afterwards. Perfect.
Well, thank you very much for that in-depth talk. Very interesting. Thank you. And on behalf of Manitoba Ag Days, a little gift for you.
Thank you.
Thank you.
Yeah.